you are going to get potentially a month here where the market does pull back. So again, the important thing about that is to always, kind of look at your portfolio, look at the risk you're taking. November, December, we could have a bit of a pullback. And we had a decently sloppy December and January last year. So again, it can happen. We're all kind of expecting the Santa Claus rally. I'm just saying that there are some risks here, at least worth paying attention to. And that kind of brings us to what you need to know before the bell this morning. This is a monthly chart of the S&P 500. So you'll notice that we have now gone 6 straight months in a row now of higher asset prices for the market. Now, that's not abnormal, but it's long. That's a very long stretch of positive monthly gains in the markets, and we do that from time to time. We've seen these before. We have had longer stretches. We've gone 7 months in a row back in 2021. We went a little bit longer stretch, about 9 months in a row back in 2017. But you kind of have to go back in time to find these longer stretches. Once you get to 6-7 months of advances in the markets in a row, you typically get a little bit of a pullback. Now, that doesn't mean that you have a very, like a huge, massive decline, right? I'm not saying that at all. Although that has happened, the last time we kind of had this very long stretch, we wound up in 2022. But you are going to get potentially a month here where the market does pull back. So again, the important thing about that is to always, kind of look at your portfolio, look at the risk you're taking. November, December, we could have a bit of a pullback. And we had a decently sloppy December and January last year. So again, it can happen. We're all kind of expecting the Santa Claus rally. I'm just saying that there are some risks here, at least worth paying attention to. Markets are very overbought on a momentum basis. They're very, very overbought on a relative strength basis as well. So again, when you kind of have these very big, kind of 3 things. 1, big deviations from long-term moving averages. So when you start looking at the deviation currently between where the market's trading now and the 20-month moving average, it's almost 2 years. That's a pretty big gap. That's going to reverse here at some point, and you can kind of see back in history that it can stay that way for a while, but you eventually get these reversions back to the mean. That happens repeatedly, and it happens when you have these very big kind of overbought conditions in the market. So when you have these big overbought conditions, you typically get pullbacks to the means. That happens repeatedly through time. And again, we've kind of got that same setup right now. So the risk is that you're going to get at least a month where markets trade a little bit more sloppily. Is that this month? Is it next month? Don't know. You're in a very strong momentum run right now that can last for a while. So again, we could go 6, 7, 8 months. That's, it's not unprecedented to have 7, 8 months in a row, but we are getting to that point to where you're going to have a bit more stock volatility and pullbacks in the overall market. So at least something to be thinking about in terms of the risk you're taking in your portfolio. And I know right now it doesn't seem like there's much risk at all in the markets, but this is when you start building those risks. So again, you'll kind of think about taking profits, rebalancing risk, just do some repositioning, maybe add a little bit of defensive to your portfolio. Certainly couldn't hurt you at this point as well, particularly as we head into year end. That's what you need to know before the bell this morning.